You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone. We're back. We are back. It's just me and Hamish today. No more Tom.
Yeah.
Yep, we left him. Where did we leave him? Houston. No. Yeah?
Houston. Yes. Yeah, that's where.
Oh my gosh, so much has happened since then.
Has it? Yeah, I guess quite a lot did happen. We had a lot of fun in Orlando. Had a bit of a relaxing time. I think the rest of the holiday was kind of half holiday, half business, mostly business really. Well, just kind of getting some work done. So,
according to the ATO, it was anyway.
Yeah, exactly. Sorry. What am I talking about? The entire trip.
That's it. But yeah, no, it was actually really good having Tom on for the last 3 podcasts.
Yeah.
It's good to hang out with him. Good to meet him finally and have a great trip through the US with him as well.
Yeah, there'll be some people disappointed that Tom's not with us this week, but we'll have to.
Yeah,
we'll get him back on for a few.
We got a couple of comments saying that that they want Tom on every week. So,
yeah,
I don't know. Mate, we'll put it to him, but he's a busy man. He is a busy man.
Yeah,
because he's got a full-time job and then he does his podcast and then he does his YouTube channel. So he's got like so much on the go. But no, it was very good to have you on, Tom, for the last 3 episodes. So thank you very much for giving your time up, and thanks for joining us as well throughout the States. That was a lot of fun. But yeah, we left him in Houston, and then onwards we went to Orlando. We went to Kennedy Space Center. Got to see the space shuttle. This kind of, because now we're back in Australia, this feels like it was a very long time ago for me
doesn't
now.
It? Yeah. Oh man. Yeah, that was a lot of fun.
So much has happened between so much. Brains have been fried. We've been here, there, and everywhere. But
yeah. No, the Space Center was a lot of fun. I really know very, very little about space, but it's a fascinating topic to me. So I enjoyed kind of going through and learning about the different Apollo missions and just things that, I don't know, just things along the Apollo missions that I hadn't kind of heard before. I mean, I didn't even know which one was the one where they landed on the moon for the first time. So that's how much I knew.
Yeah, I don't know that full history, but I could definitely spot the Saturn V rocket, and I could definitely spot the space shuttle. That's pretty easy. But I knew I knew most of the Mars rovers, but I'm not like a massive space nerd, but it was just cool seeing like how, especially with the Apollo stuff, how they were able to do that like back in the 60s.
Yeah, with the technology that they had at the time
insane.
Was insane. There's a quote about that, right? About how the tech they had was like less than a cell phone or something like that to get to the moon.
Like less than an iPhone.
Something insane like that. I can't remember the numbers, but it was in like kilobits was the amount of data that they were using and that sort of thing. But yeah, it's just insane it's amazing what they were able to do, and just seeing the rockets, kind of all the models of the rockets and that sort of thing it was pretty awesome. Very impressive.
So we saw Space Shuttle Atlantis. So that was, I think, one of the last ones. Maybe the second last one. I can't remember. Anyway, It was very cool. And then the next couple of days, we just went on a very businessy trip to Universal Studios.
100% business. We were there for one purpose and one purpose only.
Well, I recorded a video there, so there we go.
We went there for B-roll, and if we happened to ride the roller coasters, there was just a secondary kind of...
Yeah.
You have to you have to take a break.
Well, we needed to get the full experience so that we could
appreciate
speak
it
confidently in our video, my video. I needed to have the full understanding. I was trying to understand the business, Hamish. That's what I was trying to do.
Sue me.
No, it was great fun. Great fun.
No, that was
Favorite
good.
roller coaster?
Oh God, names of them. I think that
you like the Hulk one,
Jurassic Park one. was crazy.
Velocicoaster?
Yeah, I think that was
cool.
probably the craziest roll. I've never been on a roller coaster. Well, first of all, I am not a big roller coaster person. And the first thing Brandon says to me as soon as we walk into the park is, Hamish, you're going on every roller coaster with me. So I'm like, okay. But it was great. Yeah, I actually really enjoy roller coasters. I'm just terrified of them. So having someone like pull me by the neck
I'm glad I did that. Good. Literally the first thing as we walked into the park, I got you on that first roller coaster because you were like umming and ahhing. You're like, oh, look, man, I don't know about this. So I was like, no, just get on. Because once you did the first one, you were totally fine. Yeah.
No, they were a lot of fun. That first roller coaster, I'm pretty sure I got a concussion from it.
Yeah. How's your head?
Yeah, it's a little bit better. The first roll, I don't know what it was called, but it's really
the Hollywood Rip Ride Rocket.
Okay, there you go. I don't know if anyone else has been on that roller coaster, but it's really rough. Like I hit my head on the chair a couple of times going around, and we did that roller coaster I think 3 or 4 times just back to back, like literally back to back because we had the express pass like at one moment, and I'm pretty sure on one of those I like blacked out for a little bit on it, but I'm okay. So
it was a lot of fun.
Yeah,
it was a lot of fun. And then so we spent a couple of days going to Universal, and then that was it. That was our trip. We got on a flight from Orlando to LAX.
It was a bit of an ordeal.
That was such an ordeal.
Yeah. So where did that start? So we went to Orlando, of course, and it was a connecting flight between Orlando to LAX and then LAX to Sydney. So that was kind of our plan. And there was about an hour and a half layover in between the 2 flights at LAX. So we had a little bit of time, but not, a crazy amount if there was delays. And then, as soon as we got to the airport in Orlando, it started kind of raining and there was thunderstorms, then there was lightning. And then I guess they grounded all of the flights, I think, at least the ones that were around us. They grounded them for about 45 minutes or so. So we were getting kind of nervous thinking, oh, this is going to be a tight squeeze. But the amount of time we were actually in the terminal for the delay wasn't all that long, I felt like. it was about 45 minutes. We still had some time. So anyway, we get on the plane and I don't know how far into the plane, but the pilot says, oh, sorry for the delay. We'll be arriving in LAX at whatever it was, 10:45. And we just look at each other knowing that our flight leaves at 10:45. So,
the stress.
So this entire 6-hour flight, we're just kind of not really having the greatest time thinking, oh my goodness, because not only would we have to reschedule a flight, which I couldn't see any actual direct flights to Sydney that night. So we would have had to book another night or book a night.
The same time the next day
in LA. But Brandon had his bus to go to Canberra that was already planned out, and I had a flight from Sydney to Melbourne, which I would have had to cancel and then rebook. So it was a little bit nerve-wracking, I think, while we were on that flight. They were very nice to us. On that flight,
nice.
The flight attendants, I think, were a little bit. It must have just been us, right? That were had this connecting flight.
Yeah.
So I think the flight attendants felt a little bit bad because we were delayed by their flight. So they gave us like these care packages of like all these snacks from the plane, which was
they had written
nice.
On the napkin. They said, "Sorry, our delay made you miss your next connecting flight," or something like that.
I put it on
They literally handwritten that on a napkin. They chucked like chips and gummy bears and protein bars, just like the plain snacks. But they'd made us a little care package in a Ziploc bag with all that. Plus a little bit of Jack Daniels as well, which is kind of funny.
Yeah, that was pretty good. That's probably the best thing they put in there because of the value. I mean, what are they? They're like $10 each. So that was a bit of a score. I didn't even notice that was in there. But they did that. I put it on my Twitter, by the way, if anyone wants to see the care package. So you can go check that out. I've recently created a Twitter. Tom kind of convinced me that Twitter is the place to be for people discussing investing and finance related topics, and it certainly is. So I've been slowly sinking into the Twitterverse, although it is a bit of a time waster, I think. So I'm trying not to let it consume me too much. But yes, then what happened? So we got into LA, and I think when we got in, it was 10:45, 10:50. So it was right around the time our flight was going to leave. I think getting off the plane, we're just thinking we'll kind of rush over to the gate, but the plane. By the time we get there, it's LAX. We have to go get a shuttle and run across it was pretty far away. So we thought there was a pretty small chance. But as soon as we got off, there was kind of people waiting there saying, "Are you guys for the Sydney flight? Go, go, go." So we said,
like, onward.
So we had these
quick.
people kind of like throughout the terminal. There was a couple of points across the terminal where we're just sprinting through LAX now thinking, crap, maybe we can make it. Because I did actually check my phone when we landed, and it then said the flight was delayed. So we thought, oh, maybe they're delaying the flight for us, hopefully. So we sprinted through, and then we ran with like packs of like 8 kilos with our laptop and our cameras and battery bags.
I was so out of breath, man. I was absolutely cooked.
So I was dead about halfway through that run as well. But we ran for about, I reckon, like close to 10 minutes. It was quite a far run. Then we had to wait for this shuttle that was kind of on the tarmac. We waited nervously, got on the shuttle. They took us to the plane, and we got on the plane. And
we made it.
They took off immediately as soon as we got on, which we felt very, very was very, very generous of them. Yeah, I felt guilty. Yeah, it's not exactly fun being the last person on the plane when it's delayed.
No.
At that point, when it took off was 11:30, so it was 45 minutes delayed, and we pretty much think it was.
They held it for us, man. They held it for us.
Yeah,
unbelievable.
We got some looks when we came in out of breath onto the plane, which is fair enough.
Yeah.
But
man, I was like, everybody's just sitting down. Like some people are nodding off, and like all of a sudden, 2 Australian dudes just hop on this. Well, I guess most of them are Australian on this flight going back to Australia. But anyway, we're just hopping on, and we're like. Everyone's like, God damn, you two. Should have left you guys at the gate. But anyway, we're very, very thankful. So now we feel guilty because we held everyone up, but we also got a free care package.
Yeah, true. We got the best of both
for an event
worlds.
that didn't happen.
Yeah, exactly. No, I guess we kind of did deserve the care package though, because even though we were able to run across the terminal and get onto the plane, our bags were not able to get onto the plane. So we had a kind of a lost bag situation. What day are we at? Now we're at Thursday, and we came in on Sunday, and I just got my bag with pretty much everything I own in there.
Yeah. So I think I had mine 2 days later. You've got yours like 4 days later or something.
Yeah.
Or one day later from I can't remember. But anyway, yes, it was very unfortunate. We made it, but our bags did not. So
yeah.
all of our stuff, all of our clothes, all of my camera equipment was in my bag, was in my big bag. So that was actually quite annoying because, I deliberately, left myself like I was coming back, and then I was back at work the next day filming videos, recording stuff, and just didn't have anything. So it was quite annoying, but it is what it is.
Yeah, I would rather lose my bags and have gotten on that plane like we did than to not get on the plane and have our bags, because that would have just been so stressful.
Be in
dealing
LA
with
for
insurance and having to find a place last minute and then rebooking other flights.
Absolutely.
That would have been an absolute nightmare. And we were exhausted by that point anyway. It was pretty late. We
were spent.
Yeah, so everything works out in the end though. It's all right. It
does.
It's an experience. We've got a story.
That's the main thing.
We got 15 minutes for the podcast, so that's worth every second of stress.
True. And with that said, so that was the ending to our trip to the States. But overall, absolutely fantastic trip.
So good.
I loved it.
Yeah.
That was so much fun hanging out with you and with Tom, going to the Berkshire meeting. That feels like a lifetime ago at this point. Meeting Monish Prabrai and Lee Lu and Guy Spear, Matt Peterson, all of these folks, seeing Warren and Charlie in the flesh, the whole trip really, being able to have a bit of a holiday and spend some time with you guys. That I was just, honestly, I couldn't have asked for more. That was such a great trip. Yeah, that was just an unbelievable experience. We got to meet so many more people than I thought we would, and just have conversations that I never thought I would have been having over there. And to everyone as well at the Berkshire meeting that came up to us and said hello, like we felt like celebrities over there. It was absolutely mind blowing how many people. I mean, we're just 2 dudes from Australia, like. And we go to Omaha of all places. I guess it's like the value investing hub that weekend, but still, it blew my mind just how many people came up to us and said hello and talked about, they follow the podcast or they watch our YouTube channels. So it was awesome to meet everyone. So if you came up and said hello, thank you very much.
Yes,
it was really cool to talk to everybody. Really cool.
Yeah.
Loved it.
Such a different experience. I mean, both of us back here in Melbourne and you in Canberra, it's very, very rare that someone comes up and
quite rare.
It's very rare that someone comes up and is watching the channel or listens to the podcast. So to have that experience where it was kind of this condensed value investing event and there was just so many of you was an incredible experience.
It was bonkers. Yeah.
All right.
All right. Shall we? Suppose now we should actually talk about something to do with the stock market. We've spent the last couple. Thanks for sticking with us over the last couple of weeks. If you if you've listened to or watched the last couple of episodes, because we haven't really been discussing news. We've just been talking about our trip. But it was a special trip. So I would have felt like something was missing if we'd just spoken about news but not spoken about the trip.
Oh, for sure. Yeah.
But we are home and we do have some news to go through. We've got quite a bit actually, so much so I don't think we'll get through it all.
No, I don't think we will.
We got inflation stuff, Federal Reserve stuff, Chinese tech crackdowns. We've got Elon Musk potentially Twitter takeovers on hold. I don't know if you saw that, but that's pretty crazy. Netflix story. We got talking about retail stocks. There's a lot to. There's a lot to talk about, so we'll see how we go.
We'll see how we go. Let's do something we haven't done, I think, in 2 or 3 weeks. A sponsored segment. I know that's you guys' favorite when we do this sponsored segment.
You're going to have to double time it, Hamish. Let's go. This episode is sponsored by Sharesight. Go. Boom.
Gee, I can't double time it and do it for the first time in 3 weeks. I need to work into it, okay? All right.
Oh, okay.
Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you guys know it can bring in all of your trades either automatically or you can do it one by one manually or using Excel, and it will track all of your gains in your portfolio, capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports. I believe it's 12 at the moment. It might be 13.
It's a lot of reports.
They're adding new reports kind of every now and then, but I think it's about 12 different reports that can be used to track the performance of your portfolio and use the tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. Use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can also use that link to sign up to a paid plan for more features and get 4 months off a yearly subscription if you sign up now. So go check it out if you're interested.
4 months free.
Woohoo!
That's a big discount. All right. Geez, where do you want to start, Hamish Hodder?
You can take us. Where do you want to start?
Also, funny note, it's quite hilarious that Hamish is just not a name in the States. How funny is Hamish, I feel like I know a lot of Hamishes. Tom from New Zealand, he knows Hamishes. Hamish is a common name. We go over to the States. Hamesh, order for Hames, order for Hames. Amish.
Yeah, I don't know.
No, it's just not a name. They don't quite get the Hamish of it.
No, it's not really a common name, I think, but it's people in Australia get it. That there's no issue with it. Like if I say my name is Hamish and someone's writing out a form, they know how to spell it.
Easy.
Maybe it's the accent. I don't know. That was an interesting experience.
There you go.
But
Fun fact. Oh wait, I think I said that on last week's podcast.
Yeah, we did. That's why there was a ton of comments about it.
Right.
Yeah, that's
Oops, my bad. Anyway, but now you know again. Where are we starting, Hamish?
Do you want to take us through some Elon Musk stuff? I feel like we've spoken about Elon. We have a little bit, but yeah.
This won't take too long. So Elon Musk is halting his takeover plans for Twitter. And the reason for that is he wants to investigate whether fake accounts only account for 5% of Twitter's user numbers.
Now,
so
all I was going to say is Guy Spear made an interesting comment about this on Twitter just before, which is, why did he not look into that before he agreed to buy the company?
Well, here's why I think.
Okay.
It says, this is what the article says. It says, in its first quarter financial filing this year, Twitter acknowledged there are a number of false or spam accounts on its platform, alongside legitimate monetizable daily active usage or users, MDAUs. The company said it estimated the average of false or spam accounts represented fewer than 5% of MDAUs during that period. So I think that's probably why he didn't take the time to investigate it himself, maybe, is because this is actually like a published figure by Twitter themselves. Like they publicly state and put in regulatory filings that the number of fake accounts is 5%.
Yeah. Right.
So unless there's some funny business going on, you should be able to trust those filings because, they're official corporate filings that are regulated, by the Securities and Exchange Commission.
Yeah.
And interestingly, he also threw a little jab at the SEC, Elon did, because he wrote a joke Twitter poll on Tuesday. And he was saying, Twitter claims that over 95% of daily active users are real, unique humans. Does anyone have that experience? And then they were just it was just a joke poll. But he then said in a response to a follower who suggested the SEC begin an investigation, he said, quote, "Hello at SEC Gov. Anyone home?" So... Elon clearly suggesting the SEC should be looking into these user numbers, but interesting that he really clearly doesn't believe that the management's 5% figure is trustworthy.
Yeah, it is. It is an interesting situation because there are bot accounts, obviously, that have utility on Twitter. This is something I am not super familiar with, but I've seen people bring it to attention, accounts that kind of automatically grab tweets and maybe repurpose them or save them, or there's utility bots that are on Twitter that are not bad. Like you should be able to use a bot.
I was going to say the account which tracks Elon's private jet.
Right. Okay. Yeah. So
that's a bot.
Yeah. So
that's an automated. That's completely automated.
Yeah, and that has utility. So there's no. That should be okay. That account should be okay. But obviously, there's bots that are like fake or spammy bot accounts. So it's kind of an interesting nuance of how, because you can't just eliminate all bot accounts. There has to be some kind of process to be there should be some kind of process to be like a verified utility bot or a way to distinguish between the two. But yeah, kind of interesting.
Yeah, so he clearly doesn't believe that 95% of Twitter users are legit. The article says Musk agreed to buy Twitter last month for $44 billion. Yes, we know that, but has since said the deal is on pause as he looks into the bots. Yep, we know that. Twitter has said it still expects the transaction to go through at the agreed upon price of $54.20 a share. Investors have been, this is the interesting thing, Hamish, investors have been dumping the shares on concerns that Musk is going to abandon the agreement. Have you seen what's happened to the stock by chance?
I haven't seen exactly what's happened, but it's come off quite considerably. I think it's back below before the announcement, right?
Yes. So that's what I was going to say. Elon announced his initial, I wrote this down, he announced his initial 9% stake in the company on the 2nd of April. Stock went from 39 to 51, so up 30%. Now he's announced the Twitter deal is on hold, and the shares are, so they went from 39 to 51, and now they're at 36.
Yeah, wow.
So it went up, then all the way down.
He was in a bit of trouble, right? Because he was 10 days late to disclose his investment. And
he's such a loose cannon.
Someone worked out that he saved like $130 million or something by doing that. So here's my conspiracy theory. I think that he's talking about this to push the stock price down so that when the SEC investigates, it doesn't look like he actually had any material gain by not disclosing at the correct time. There's my conspiracy theory. Because
that is a conspiracy theory, but it makes sense, doesn't it?
So there you go. That's my little Musk is manipulating the stock again conspiracy. It's not the first time he's tried to manipulate something. No, I don't know if that's true.
No. There you go. I hadn't even thought of that, but there you go.
I don't even know if that's how that works either. I don't know he still didn't file on time, so I presume that's still a crime to some extent. But I would imagine that the amount gained in value has some kind of merit on what the punishment is for being late with filing. So I don't know.
Maybe, yeah. Interesting that Elon, I didn't really know that this existed, but I guess it makes sense that Elon cops a financial penalty if he backs out of the agreement.
Right. Okay.
Guess how much?
Yeah. I don't know.
If he agrees to go through the acquisition and then he gets cold feet and he says, no. Twitter have put in a clause that say, no, you will cop essentially a fine for backing out of the deal.
Well,
guess how much?
I don't know, but I'm guessing since it's a $44 billion deal, it's quite high. Is it in the hundreds of millions or?
It's $1 billion.
Woo! Yeah, I mean,
if he steps down, it's $1 billion that he has to give up.
I mean, that makes sense. He's signed an agreement to buy the company. I mean, it makes sense that there would be some kind of clause.
It's $1 billion.
Yeah, it is a lot. What is that? I guess it's like 2% of the transaction value. So
yeah, that's huge. In relative terms, maybe it's not so big, but in absolute terms,
it is crazy.
That's
insane.
ridiculous.
Yeah,
it's just like, I've decided not to go through. Damn, I'm going to lose $1 billion if I don't go through with it.
Yeah, I don't think he's going to back out of the deal. I think he's having fun.
No.
I think he's having fun talking a lot of smack on Twitter at the moment.
He loves it. He's been chatting very political lately. Very, more so than usual. Very political.
Yeah.
He was talking about how he's going to vote Republican and how he's talking about he hates the left now, the woke mind virus or some crazy. He's really going at it.
Yeah, I wonder. I don't know where that's kind of. He's very active in politics now. Maybe it has something to do with the midterm elections, which are coming up in the US. Maybe, but I don't know. Yeah, I think on this topic, I think he tweeted today that what it was like half of Joe Biden's followers were bot accounts or something.
that would be kind of funny.
It was
it's social media at the moment is just rife with bots and spam.
It's horrible.
It's been like a trend. It's always been there.
Yeah.
But I feel like in the past 3 years or so, around about that time, Instagram, Twitter, YouTube, so much spam.
Yeah.
So many bots.
Yeah.
It's like next level. It's actually next level how many spam and bot accounts there are.
Yeah.
All you have to do is look at our comment sections.
Yeah.
I mean, there's more bots and spam than there are legitimate comments. The comment section on YouTube is basically ruined now because there's no one real that's commenting.
Yeah. And Musk's discussion about potentially paying a fee to then go through the verification process, it makes I had never really thought about that until Musk brought it up a little while ago, but it makes perfect sense. And I think every platform will eventually do that because then as a creator, maybe we can limit comments to verified accounts and then there can't be spam fake accounts because I think I just think there's going to be a lot of value. Well, there is a lot of value in being verified to the platform and to the individual. So I think that's a no-brainer for them to do that. What that looks like, how much that is, I don't know. But as soon as they charge some level of amount of money, they can hire more people to go through the verification process. That's the bottleneck at the moment is they need to a human needs to verify whatever information you're providing to say this is your real account. And there's not really a huge incentive for them to hire more people to speed up that process unless they're getting paid to do it. So if YouTube or Twitter can get paid, then they can hire people to do it and make it really, really snappy, really quick, like a 1 week turnaround or whatever. I think that could be really valuable. And I think a lot of people will pay. As I spoke about, I think 2 weeks ago on the podcast, I think there will be a lot of people that will pay for that, especially businesses and public figures and that sort of thing.
Yeah, for sure. So there we go. Twitter deal on hold. What would you like to talk about next, Hamish Hodder?
We better talk about inflation because...
Of course.
We couldn't go a week without talking about inflation. Don't be ridiculous, Brandon.
We probably did go a week. Did we talk about it last week? Probably not.
I don't think we did. No, we didn't really talk about... Maybe.
Oh, and we didn't even do a podcast last week, so apologies for that, guys. But things got real hectic over in the States. They got extremely busy. So but we were actually planning on doing another one, but... It just didn't work out. We were so busy, so fried. but we don't want to put out a bad podcast. So we thought better to not try and like force something, better just to chill out, get our head back in the right space, get back to Australia, come back fresh. So apologies and apologies as well because the scheduling was a bit off, just because obviously while we're in America, we had a lot of events that we had on. So that was why the scheduling, like normally we're on for us anyway, Saturday mornings. When's the podcast come out? Like 6 a.m.
Yeah.
And it's like clockwork pretty much. But yeah, I think we were like a few days late and then a few days early or something. So apologies for that, but we're back now. Regular programming resumes.
Like how we do that apology 30 minutes into the podcast.
Yeah. So yeah, true. Not at the top or anything.
No, that's okay. But yeah, we'll talk about inflation because we've got some updates. So 8 days ago we had the monthly inflation data come out. So I'm a little bit late on that, and some of you have probably heard the headlines of this, but we can talk about it in the context of a Jerome Powell interview or discussion that took place this week, or I think it was just yesterday that it happened. So there's a few updates to kind of talk about. So we got April inflation and CPI data. Year-over-year inflation as of the end of April, it must be, was 8.3%. So it's down from 8.5% in the previous month. But
it's down, Hamish.
It's down, yeah.
Problem solved.
Inflation has peaked. How many times? When was the last time? I think it was towards the middle or the end of last year. We hit kind of like 6% and then it went down to like 5.5 and everyone was like, see, it's transitory.
We're good. We're good now, guy. Yeah, probably Jerome was saying that as well.
Yeah. So, so it came off a little bit. And that's because the month-over-month increase was quite a bit smaller. It was 0.3%, so still a significant month-over-month increase, but down from the 0.8% that happened in March. So last month we had the oil surges and all of that
that's
sort of
what it was.
Shenanigans. So there was a big increase last month.
Yeah, I was just going to say, the fact that we're still at like 8.3 and we didn't have the big oil crisis in this month, that's pretty staggering.
Yeah, well, if you look at, so even though overall inflation went up 0.3%, core inflation, which excludes energy, went up 0.6%. So core was very, very high. And the reason for that is because energy prices actually went down this month from the previous month, which makes perfect sense. Last month was this huge surge. It cooled down a little bit. So we expected to see, or it was reasonable to expect that energy prices would come down, which they did. But core inflation, which excludes food and energy costs, continued to surge at a really high rate, which is very concerning. So there's that. Year to date.
Wow. So there's that. So just gotta put that there.
Year to date, 4 months. Year to date's been a fun one for me to kind of watch because of Jerome Powell's estimation of inflation being 2.4% or something this year. 4 months into the year, we're at 2.9. So as we said last month, deflation to come for the remainder of the year.
Well, of course. Well, by Jerome's standards, I mean, that's what he should be. If he genuinely believes in the 2.4% or whatever it was, he should be standing up and saying, look, we're going to get deflation back down to 2.4.
Yeah. No, exactly. No, but I don't know if they've updated. They might have updated their
maybe
their prediction.
But it is kind of funny.
It is funny. That's what they said at the start of the year when inflation was at like 6 or 7% already. So
I reckon his 2023 inflation guess will be like 2.5%.
Yeah.
It went from 2 to 2.4, or maybe he'll go up to 2.6.
Yeah.
Who knows?
Yeah, who knows? He might go wild, 2.7 or something like that. Core CPI, excluding food and energy, for the year-over-year was 6.2%. So that's still surging at an incredibly high rate. Food and energy have been two big contributors to inflation. So even excluding them, the fact that they're at 6.2% is pretty high. Wages is something we can kind of think about in the context of inflation. Nominal wages, so before inflation, were up 0.3% for the month, but which makes sense because there's a labor shortage, so businesses are willing to pay more to hire. But real wages was down 0.1, so didn't outpace inflation. And then if you look at it over a 12-month period, it's even worse. So wages on an hourly basis have increased 5.5%, which is great. You want to see wages increase, but in real terms, after inflation, down 2.6%. So
everyone's worse off.
Yeah, and that's kind of that's the struggle at the moment for businesses: rising costs, labor and food, and for individuals, rising costs. Their wages are going up, but not fast enough to outpace inflation.
That's the brutal thing. That's what's really brutal.
Yeah,
is that people really lose out.
Yeah, and then it starts to squeeze businesses that have higher costs, and they look for ways to cut costs. And that puts downward pressure on people's income. So it's not a great economic environment at the moment. And we've known this for a while, I think. And look, this has kind of been an evolving situation for 12, 18 months now, but it's really starting to kind of show in the data. But on that, so that was about a week ago, Jerome Powell sat down, I think yesterday or the day before, with the Wall Street Journal to kind of answer some questions about the economy. And kind of the highlights of what he said. He said that it's his focus to get inflation down, which is good.
You'd hope.
He's finally saying it. A couple of quotes. He said, if that involves moving past broadly understood levels of neutral, we won't hesitate to do that. So essentially saying they're willing to push interest rates to where it needs to go. We will go until we feel we are at a place where we can say financial conditions are in an appropriate place. We see inflation coming down. We'll go to that point. There won't be any hesitation about that. So he's saying he's going to be tough on inflation, continuing to push interest rates. Where interest rates are up to 0.75%, I think. And the last hike was a 0.5% hike. So I think it's not out of the question that we will see some 0.5% or even higher monthly increases in the federal funds rate, which I think will probably be necessary. But yeah, it's a tough position for Powell because they need to raise interest rates to get inflation under control, probably quite significantly. And the balance of that is last quarter, US GDP already contracted by 1.4%. So even the small amount of interest rate increases and inflation has already hit the economy. So you can imagine if there are significantly more interest rate hikes to come, that it's probably not going to get better broadly. So that's the tough balance that Jerome Powell is dealing with.
I wouldn't like to be him, but
no.
It's like essentially what he's doing now is choosing the lesser of two evils.
Yeah.
What's going to be the lesser of two evils? Do we crank rates or do we let inflation go?
Yeah.
And obviously you can't just let inflation go. It'll just run away from you. So you have to crank rates.
Yeah.
But cranking rates is not a nice thing to do.
No.
Because you just put the clamps on people and businesses. But I mean, really at the end of the day, businesses are entities. You put the clamp on people. That's the rough thing, is that everybody's costs get higher. So they essentially have less money for everything else.
Yeah.
So it's just really, really rough. But I mean, I think we got to just try and prepare as best we can. I mean, just from an individual perspective, like if you've got mortgages, variable rate loans, you got to right now really open your eyes and go, nah, these rates are going to go up. I am going to pay more in interest for my debts.
Yep.
So go in with that mindset. Say, no, don't go in with the mindset, oh, maybe not. Just go in with the mindset, it is going to go up. Try and get yourself in that financial position where you're going to be minimally or as minimally impacted as possible, I guess. But
and
it's rough.
Yeah, and it's another reason to focus on businesses. It's why it's so important to look at how easily a business can cover their interest obligations, because it's one thing to be covering your interest obligations when you've got these 5-year loans or 5-year bond. The business has got 5-year bonds at 1%, and then all of a sudden that's 6%, because that's all they can get. That's big. That's a big increase in their interest rates. So being able to cover those is kind of important. And then on interest rates, we can kind of look at how...
It's kind of important.
It's a little important. It's a little thing called Chapter 11 bankruptcy, but we won't get into that today. The bond market. So the bond market is expecting there to be continued rate hikes. A 10-year bond rate is at 2.9%, which is twice as high as it was just a year ago. So that tells us very clearly, 3% on the long-term bond, that the market is expecting there to be more rate hikes in the future. And if you look at the chart for that, for the bond yields, it's kind of astounding. It's just been like a vertical line up as people have demanded higher yields on bonds because they believe that interest rates will continue to go up. So new bonds will be printed with a higher interest rate attached to them. So that's what's going on. It's not a nice environment, I think, at the moment. And we've seen that play out in the stock market, especially tech has been absolutely crushed. Which, I mean, that's, just speaks to the importance of valuation, focusing on businesses that produce. Something we may have spoken about, I think, once or twice on this podcast, maybe. It's fine.
We got to be careful with the use of sarcasm, remember, Hamish?
Yeah, sorry. Rivian bad.
Yes, we have spoken about valuation. We speak about it a lot.
Yeah, very, very important. But I mean, there's a lot of companies that are down 80, 70, 80, 90% now. So
it's pretty incredible. There's we haven't really explicitly spoken about this whole stock market, like the broader stock market.
No. Yeah. And
it's we're at a point in time where it's really dropped off a lot. I'm trying to get S&P 500.
The thing to remember, I mean, you might look at the NASDAQ and see it's only down 25% or something like that. Remember how heavily weighted that is with just a handful of companies. It's all that we have Google at the top and Apple. These companies, I think it's like 10 companies make up almost like a third of the entire market cap. So when you see the NASDAQ overall, it's not the greatest indication of what individual companies are doing. Because if you look at individual companies, smaller companies in particular that are very lightly weighted in the NASDAQ, for example, or even the S&P 500, a lot of them have been absolutely destroyed. So there's kind of that to consider. But I mean, Rivian I think has been kind of a fun one to watch because it was an absurd valuation and it's finally coming back down into reality. Because interest rates are going up and the business doesn't produce anything.
Yeah. I just looked it up. The S&P's down 18.2% year to date.
There you go. So, and it was falling since I think September or so. So it's been painful for the NASDAQ, but that was the S&P. Oh, sorry, that was the S&P.
I'm just looking at the NASDAQ's down 28% year to date.
Yeah.
So there you go.
There you go.
Yes.
But when there is pain, there is opportunity. It's not uncommon for markets to go from being euphoric to being overly pessimistic. So keeping an eye out for where the market has sold something down well below what it should is what value investors do. So,
these are the time, like this kind of time is the time where the gamblers get burnt out. Yep. The short-term investors get absolutely torched, but the long-term investors really get going, This is where we've been kind of hiding in the shadows for a while, and now is the time where we kind of pounce these kind of conditions. So keep an eye on your watch list, that's for sure.
Yeah, everyone who's been kind of whispering, or not whispering, yelling, I guess, that value has underperformed tech or growth for I think over a decade, 15 years or something like that. Yeah, that's not true anymore. So
value doesn't go out of style.
No, it maybe for periods of time it will underperform for sure. But over the long term, value seems to ring true. What was it? There's a nice chart of the ARK portfolio or the ARK index from Kathy Wood. Is it Kathy Woods? Kathy Wood. And how much she was outperforming Berkshire. But now I think Berkshire is in front after this recent collapse. So there you go.
You can't go wrong with that. Buying $1 for 50 cents never doesn't work. So there's that.
That's a good point.
All right, shall we move on?
Yeah. What do you want to talk about?
I think
We're probably
I want to get your opinion on this.
Okay.
Maybe we can leave China tech crackdown for next week, potentially, because I do want to get your opinion on this.
Yeah.
Netflix cuts 150 staff in a cost-cutting effort. Did you see this?
I did. Yeah.
Yeah. You have been doing so much research on Netflix lately.
Yeah.
It's actually been crazy. Like on the plane, you were reading books about Netflix. When we got off the plane, you were listening to podcasts about Netflix. It's fair to say you are going very deep.
It's fair to say I've been very, very annoying as well, because this is what happens with me. I kind of get sucked into something, and it'll be all I'll be reading about and listening and everything, and then I have nothing else to talk about. So every spare moment, I'm just like, there'll be a second of silence. You're like at the airport, we're just sitting at the airport, and I'll be like, oh yeah, so by the way, engagement in India was just harp on about.
So Reed Hastings.
So I just read this thing in this book. So yeah, I've kind of been a bit annoying, but it's been good. It's been
good. So I want to get your opinion on this. Okay, so the title is Netflix lays off 150 employees as the streaming service contends with big subscriber losses, which sounds very sensationalist.
Dun, dun, dun.
And I immediately called clickbait, and I'll tell you why. It's because 150 employees is literally 2% of Netflix's 11,000 employees or something crazy.
Yeah.
And we know it's pretty normal for companies to have like 5 to 10% of their employees, turnover every year.
Yeah.
So this is not a crazy stat. So I thought this is total BS, complete fabrication. And then the article goes on and says the staff reductions, which were expected. It's like, all right, so now I've totally been sucked in. You're even telling me that this sensationalist headline is actually something that was already expected. So I've totally been sucked in. I've been clickbaited to the next century on essentially a non-story. But then interestingly, a Netflix spokesperson actually responded to CNBC on the topic. And they said, quote, as we explained on earnings, our slowing revenue growth means we are also having to slow our cost growth as a company. So sadly, we are letting around 150 employees go today, mostly US based. These changes are primarily driven by business needs rather than individual performance. So that kind of switched me back on, because that's interesting. It's not just, your standard churn of employees. This spokesperson is actually saying, our revenue growth is slowing, so we need to take these measures and essentially cut costs by cutting employees. So,
yeah,
I don't know. What are your thoughts on this?
Yeah, I think it's nice, and I think it's very easy to kind of write articles about Netflix and probably get a lot of clicks at the moment. So I think that kind of feeds into that. But yeah, in their earnings, they spoke about keeping cost in line with their revenue, and that's kind of been their practice over time. Is they love to drive as much of their incremental revenue back into new content, and of course into new content means new hires. And so when that slows down, it's kind of not super surprising, I think, to kind of see that they had a cost slowdown. But I think the story with Netflix at the moment, you can kind of look at it in terms of the US business and then in some of their international markets. In the US, it's a very, very tough operating environment at the moment. They increase prices, which people don't like, right? And there's been a lot of talk about that, adding some kind of a small amount of churn, which typically happens. There's increased competition at the moment. There's inflation going on, which puts pressure on individuals. So it's tough. It's a tough environment. And the other thing about the US market is it's extremely saturated for Netflix. I think they spoke about how the cable market is about 110 million subscribers in the US, and Netflix has 75 million subscribers, plus they think there's about 30 million sharing accounts. So that's 105 million out of 110. So in the US, they're saturated, right? That's the kind of the story in the US.
Yep.
Outside of the US, it's similar but different. They're not saturated, that's for sure, but definitely there are some tougher economic environments that they're working in. Latin America is struggling with inflation and weak economic growth. So that's been a big problem. They spoke about the Ukraine conflict in the latest quarterly filings, how countries in Eastern Europe kind of near it to the conflict were kind of being a little bit cautious, I guess, with their income and churning at a higher rate. So it's been a tough quarter, and they're expecting, well, they've projected for an even tougher quarter, the one that we're in right now. So it's been tough, but I think the story really for Netflix is this the first decline of Netflix having a meaningful decline in their user base because they're not satisfying customers? That's really the question. Is it that? Or is this reflective of short-term factors? And I think the narrative at the moment, for sure, the dominant narrative is that this is the end of Netflix, right? We've seen the peak.
Right.
Netflix doesn't satisfy customers. Their prices are too high. There's better competition.
That's been all the headlines, the clickbaity kind of headlines.
So Netflix is on the way down. And we'll see. I personally think what ultimately tells us whether Netflix is satisfying customers is engagement. So where are people choosing to spend their time? And Netflix crashes on engagement. But we'll see. Maybe that shifts over time. We'll get, I think in a couple of days, we'll get the new Nielsen data out of the US, which will tell us how much of people's time people are spending on watching Netflix. It recently increased. It's been increasing every month for quite some time. So we'll see if that shifts. So that's really the question. Is this a short-term issue? Because it's not the greatest economy. In the US, they're very saturated, so it's normal for them to see decreases. That's nothing new. They've had decreases in the US and increases and decreases, and they've kind of sat around 75 million for, I think, 5 or 6 quarters. So that's normal. But outside of the US, that's kind of the story as well. So we'll see. We'll see what plays out. But it's certainly not the best economic environment right now. And, Netflix is a discretionary purchase. So when people are looking for things to cut, it's one of those things they can cut. And I'm certainly in the camp that the long-term story for Netflix is fairly unchanged, in that the vast majority of the world still are subscribed to cable subscriptions, and they will be shifting over to streaming. And that doesn't hurt Netflix. That certainly helps Netflix.
So you're kind of thinking short-term pain, long-term gain kind of scenario.
I think so. Yeah. Look, I mean, that's what the people are still choosing to spend a significant amount of time watching Netflix. I think it's kind of crazy. The Nielsen data has Netflix at 6.6% of consumers' time, and YouTube at 6%. YouTube being a platform that is free, that anybody can access. So that's
a good point.
That's quite an interesting position for them to be in.
They're doing something, right?
We'll see how that changes. Of course, it's entirely possible that the pain they've had in the first quarter or the latest quarter continues and gets worse, and then it gets worse, and then it gets worse, and Netflix can't make good content. That's obviously entirely possible. That's where the stock is priced at the moment. So we'll see. Right. We'll see what happens. It's certainly not a business without risk. But yeah, from what I've looked at, that's kind of where I sit on it. But it's been fun to look into, because it's a business that I've wanted to look at for a very, very long time, but it was absolutely astronomically priced. And that's why it's kind of this double narrative of, I think a lot of people are overlooking it as an investment because it was a speculative stock. The stock was insanely speculative. I think it was at like 100 price to earnings ratio, which was absolutely insane just a few months ago. So it's coming off that, and there's certainly an element of that is why you don't want to invest in businesses without considering price. But we know that, a story like Microsoft, for example, in 2000, it went from being astronomically overvalued to becoming extremely cheap. And that didn't mean it was a bad business because it got wrapped up in the dot-com bubble.
Fair.
Anyway, do we want to make this podcast go for 3 hours? Because I've got a few more points to make.
Dear, no, that was good. I found that interesting, but yes, I think you're right. It's definitely US, and that's what they were talking about with these 150 staff being cut. They're all based in the US. I mean, the US business seems like it's pretty solidified. It's pretty almost saturated, I guess.
Yeah.
It's like some of the biggest properties over the last couple of years have been from their international efforts.
Yeah.
Like some of the I don't even know, like Korea or something. There's been a lot of popular stuff. Where was Squid Game?
Yeah, Squid Game was Korean.
That was Korea.
The number of movies from Latin American countries have done extremely well, and even European movies as well. So it's interesting to watch. I'm super excited now that Warner Media with HBO Max and Disney are really pushing on streaming because I'm excited to see what content they can make. I love the format of a limited series or a series where it's kind of like a movie that's drawn out, like a Mandalorian. I want more of those shows. So I'm glad that the legacy media companies are starting to spend more, but they're struggling because they're balancing, do we license this content out as we have previously and generate huge revenue streams, or do we put it on our own platform that doesn't have a huge subscriber base yet, that's not profitable? They have to take a bit of a leap of faith, and Disney's doing the best job at that, but we'll see how that plays out over time.
Interesting. All right. We got 5 minrit.
Let's do a question.
You want to do a question?
Yeah.
All right, we'll do a question.
Let's do a question.
All right, we'll do a question, then we'll maybe wrap things up.
All right.
Okay. And by the way, if you have a question, we haven't been plugging the Q&A section because we've just been doing these kind of weird podcasts for the last couple of weeks. But if you do have a question, a topic, anything really, you can just go over to the YouTube version of the podcast. You can see our smiling faces and head down to the comments section, drop a comment, ask a question, and we'll grab your comment and chuck it in the Google Doc.
Yeah,
we shall go through them.
I'll ask this question to you because I've been talking a lot for the past few minutes. So this question here is, I know you guys bought one stock of BRK so you could attend the meeting. We did.
Correct. We did do that.
But if you follow Buffett and Munger's principles of investing, why don't you own more shares in BRK? Good question. I would have thought you'd at least have some exposure to BRK as they have the same key value investing principles as you. Keep up the great work on the podcast and YouTube channels. Thanks, Callum from the UK. Thank you for asking a question.
I think, look, we're looking at a company that's, very diversified. We're looking at a company that's diversified across value plays, that's run by the best investor the world has ever seen. So I think there's a good argument that, you probably could just buy Berkshire Hathaway and be done with it and just leave your money with Warren and Charlie. Yeah, I think, honestly, you'd probably do pretty well. The reason that I have not bought into like a substantial position in Berkshire is just because even though I think all those things that I just said, I would be violating one of my key rules of investing, which is that I have to understand what I'm investing in. And even though Warren Buffett gets it and he's running this company, even though Charlie Munger gets it, when we're talking about insurance, and when we're talking about railroad logistics, energy companies, it's just, and that's that's just their categories of wholly owned businesses. There's all these other businesses as well, and also the stock portfolio, the partially. I just think that to me is very difficult to understand, and I don't understand it. Like, I get it at a basic level because obviously I follow Warren Buffett quite closely. But if you said, "Hey Brandon, what's the value of Berkshire Hathaway?" That I would be scratching my head. I wouldn't be able to tell you.
Yeah.
What do you reckon?
Yeah, I'm probably in the same boat. The only other thing I would add is I would probably, if this was 20 years ago, I would have probably invested in it and treated it somewhat like an index fund or like just putting money in a fund where someone's managing your money. Because I don't think Charlie and Warren have 20 years in front of them left, that's kind of my concern. I think there's a lot of value in having those two running the businesses and picking businesses within Berkshire. And I don't know what that looks like afterwards. I'm sure the managers replacing them are great. In fact, I know they are great, but they're not Charlie and they're not Warren. So that would be my kind of hesitation on that. But if this was 20 years ago, I I would have probably just invested in the company when they were repurchasing shares at some point where they have shown me that they like the stock price or something like that, right? And then I probably would, but yeah, Berkshire, I think over the next decade is it is going to change, and what that looks like for the future of Berkshire, I'm not sure.
Fair. All right, done like a dinner.
All right, getting sleepy, are we? I think we're still a little bit jet lagged.
We're sorry if we've been a bit off. I feel like we've just been a bit loopy today, but it's currently 4 p.m., which at the best of time is not a great time to record a podcast. But the reason, like, normally we wake up fresh on a Thursday morning and we record our podcast, but the reason that we're recording at 4 p.m. is we were waiting for Hamish's bag. Like we were literally waiting for him to get his equipment back so that we could record the podcast. However, so we're sorry if we're a little bit loopy or a little bit sleepy, but we got through it. That's still a solid podcast. I think we still got through the main things we needed to talk about. We actually didn't get through everything, so we'll go through some of the stuff next week, I'm sure. But yeah, thank you guys for tuning in, and thanks very much if you're tuning in. I think I already said this earlier, but thanks very much if you're tuning in the last couple of weeks as well. We really appreciate it. Following our trip to America, and again, thanks to Tom for joining us for the last 3 episodes as well. So it was a lot of fun having him on, and as we said before, head over to the YouTube version, subscribe to the podcast channel over there if you want to watch the video version of the podcast. Leave us the Q&A questions, all that stuff. What am I forgetting? Sharesight, check them out. They help keep the lights on with the podcast. We're not super into making the podcast a massive source of profit for us. We literally just use sponsorships to cover our costs. So we're not, literally the sponsorship money that we get does just keep us going. Like, we're not making bank over here off of podcasting and that sort of thing. So know that if you do sign up to Sharesight with that sponsor code, that's keeping the lights on. So appreciate that. Thanks, Hamish, for joining me, even though you are dead tired, my friend. And we'll wrap things up. We'll see you guys next week.
See you guys.